It's that feeling you get when you're standing on the roof of a skyscraper. You walk right up to the edge, you look down, and you get that sudden physical wave of vertigo.
Yeah.
That is exactly what opening a brokerage account feels like this week. I mean, the S&P 500 is pushing all-time highs. NVIDIA is swinging around by billions of dollars a day. And you just have this nagging voice in the back of your head. Maybe it's your conscience. Maybe it's just pure anxiety, but it's asking, am I the greater fool? Is this the top?
It feels like the silence before the drop, or at least that's what the fear centers of our brain are just screaming at us. And it's not irrational to feel that way.
No, not at all.
If you look at a chart of the last, 18 months, it doesn't look like a gentle slope, does it? It looks like a vertical launch.
Right, rocket ship.
Exactly. And human nature, or specifically investor nature, is just hardwired to believe that gravity always wins. So we're hearing the whispers everywhere. It's 1999. It's the dot-com bust all over again. Get out before the music stops.
The comparisons are relentless. And frankly, they're getting a little lazy. It's so easy to just point to a chart and say, that line went up too fast, so it must be a bubble.
Right.
But we aren't here for the easy answers. We're here to go deeper. We have a stack of research on the desk today that really challenges that entire doom and gloom narrative. We are looking at a Masterclass interview from Professor Aswath Damodaran.
The dean of valuation himself. I mean, if you've ever taken a serious finance course or even just, dabbled in equity research, you've probably suffered through his textbooks.
I still have nightmares about his DCF models.
Well, me too. But the man is a legend for a reason. He doesn't trade on vibes. He trades on numbers. He's at NYU Stern, and he has spent the last few weeks just dismantling this bubble narrative piece by piece.
He's really taking a scalpel to the Magnificent Seven. He's dissecting the AI hype machine, and he's actually defining mathematically what separates a rich market from a delusional one.
And spoiler alert, he thinks the doomsayers are using the wrong calculator.
Okay, let's unpack this, because if you think you know what a bubble looks like, the professor might just prove you wrong.
We're going to get into something he calls the big market delusion. We'll talk about why the PE ratio is practically garbage in this economy and why he thinks being, a little bit delusional is actually necessary for capitalism to even work.
But before we get into the professor's head, let's talk about getting into the data yourself. Because you can't just rely on headlines. You can't even rely on us, right? You need a thermometer for the market that isn't attached to a cable news chyron.
Absolutely. You need independent data points. You need to be able to see the macro view without all the spin and the noise.
To track total market temperature, welcome to search and download iOS app Buffett Indicator from Apple App Store. It's just a clean, simple way to see that macro view without getting lost in the noise of daily volatility. It helps you zoom out when everyone else is zooming in.
So let's set the stage. The source material for this whole deep dive is a really comprehensive breakdown Damodaran gave regarding the state of the market. And he starts with the one word everyone is throwing around: bubble.
It's the only word that matters right now, isn't it? Are we in one? Yes or no?
Well, Damodaran's answer is nuanced, and it frustrates people who want that simple yes or no. He says the market is richly priced.
Okay, hold on. Richly priced sounds like something a real estate agent says when a house is 50% over your budget and has a leaky roof. Is that just a polite academic way of saying overvalued?
He would say no. It's a crucial distinction. A bubble, in Damodaran's world, implies a detachment from reality. It's pure irrationality. It means people are buying things just because they think they can sell them to someone else for more in 10 minutes.
Greater fool theory.
Exactly. Richly priced, on the other hand, means price is high, yes, but it's rational if, and this is the big if you believe, the current economic environment holds.
So the market is making a bet. A big one.
A huge one. The market is pricing in what he calls a benign pathway. It assumes inflation stays down, the economy keeps growing, and, critically, earnings hold up. It assumes we aren't going to just drive off a cliff.
Which, to be fair, is a lot of assumptions. That sounds like a Goldilocks scenario.
Yeah.
Everything has to be just right. Not too hot, not too cold.
It is. But you have to look at the scoreboard, right? For the last 2 years, the bears have been screaming, recession, inflation spiral, geopolitical collapse. And what has the market done?
It's just shrugged. Stepped right over the panic and kept climbing.
The market has been right so far. The economy has been benign. Damodaran points out that even with the initial shock of tariffs or the fastest rate hikes in history, the system just absorbed it.
Okay, but the bears have one number they love to throw around, and it's a big one. The PZ ratio. The price to earnings. Yeah. Historically, the S&P 500 trades at maybe, 15 or 16 times earnings?
A long-term average, yeah.
Right now. We are pushing 25, maybe 30, depending on how you measure it. That gap That feels like bubble territory. That's usually where the crash happens.
And this is where Damodaran gets almost spicy about it. He absolutely detests the reliance on PE as a bubble indicator.
He really does.
He called it the laziest justification for a bubble. He literally said, and this is a quote, ChatGPT could do better than that.
Ouch. Why does he hate it so much, though? I mean, it's a standard metric. Every financial website lists this right next to the stock price.
Yeah.
It's Finance 101.
Think of it this way. You walk into a doctor's office, the doctor puts the thermometer in your mouth, sees it reads 99 degrees, and immediately says, you have malaria, we need to operate.
That's malpractice. You'd lose your license. You'd get sued into oblivion.
Exactly. A high temperature is a data point, not a diagnosis. You might have a fever, or you might have just run a marathon, or maybe you're sitting in a sauna. Context is everything, right?
Right.
Damodaran argues that comparing today's PE to the PE of, say, 1970 is like comparing a Ferrari to a horse and buggy. The underlying engine of the economy has fundamentally changed. This is what he calls the structural shift theory.
I always get nervous when people say, this time it's different. That's usually the last thing investors say right before they go broke.
And he acknowledges that. He says those are the four most dangerous words in investing.
So what is structurally different enough to justify paying almost double the historical average for stocks?
It comes down to two things: margins and the quality of cash flow. Look at the S&P 500 in 1980. It was dominated by industrial giants, General Motors, Exxon, GE. These were companies with massive factories, huge labor unions, pension obligations, and razor-thin margins.
Capital intensive. They needed to spend $1 to make $1.10.
Precisely. They had huge fixed costs. And if a recession hit, those factories sat empty and rusted. They started losing money fast.
Okay, so that's the old economy.
Now look at the S&P 500 today. It is 30% technology. Microsoft, Google, Meta, NVIDIA, he calls these money machines. Microsoft sells software. The marginal cost of selling one more copy of Office 365 or one more month of Xbox Game Pass is effectively zero.
There's no factory to build, no steel to buy.
Nothing. Their margins aren't 5%, they are 40% or 50%. These companies are asset light and incredibly flexible. If a downturn hits, they don't have a factory to shut down. They just scale back on, some R&D or marketing. It's a completely different business model.
So the cash cows of the 21st century are just fatter than the cows of the 20th century.
Much fatter.
And
stickier. Damodaran argues that because these companies generate such massive, stable cash flows with so little physical overhead, they deserve a higher multiple. A PE of 25 for Microsoft might be the economic equivalent of a PE of 12 for General Motors back in the day.
So if we're all sitting around waiting for the market to go back to a PE of 15.
We might be waiting for an economy that doesn't exist anymore. We'd be waiting for the horse and buggy to make a comeback.
That is a fascinating perspective. Feels like we're measuring a 21st century economy with 20th century yardsticks. We might be waiting for a mean reversion that is never going to happen because the mean itself has moved.
Exactly. You can't use a yardstick from the Industrial Revolution to measure the digital revolution.
Okay, so the broader market might be rational, or at least rationally priced. But we have to talk about the elephant in the server room, artificial intelligence.
The main of it.
Because some of these charts don't look like growth. They look like a rocket launch.
Huh?
I mean, NVIDIA added $1 trillion in market cap in what feels like a weekend. That part can't be normal.
And this is where Damodaran puts on his valuation dean hat and really separates the signal from the noise. He makes a critical distinction that I think every single investor needs to tattoo on their forehead right now. It's the difference between the architecture and the product.
Okay, let's peel that apart. Architecture first. What falls under that?
Think of architecture as the plumbing, the foundation, the electricity grid for the AI revolution. In the AI world, this is NVIDIA, first and foremost. It's the other chip makers like AMD or TSMC. It's the data center builders. It's even the energy companies like Constellation Energy that are signing these huge deals to power those data centers.
The picks and shovels.
Exactly, the picks and shovels. Damodaran calls this the easy half of the valuation puzzle.
Why easy? NVIDIA is one of the most volatile stocks on the planet right now. How is that easy?
Easy in terms of valuation, not in terms of, your stomach lining. It's easier because the cash is already in the bank. That's the key.
What do you mean?
Microsoft, Meta, Google, Amazon, they have all committed hundreds of billions of dollars to buy these chips. They have signed the purchase orders. The money has already moved from their bank account to NVIDIA's. So even if AI turns out to be a total dud next year, NVIDIA doesn't have to give that money back.
Right. It's a sunk cost for the buyers, but it's realized revenue for the sellers. It's the classic selling shovels in a gold rush. Even if nobody finds a single nugget of gold, the shovel salesman buys a yacht.
You nailed it. The shovel salesman doesn't care about the gold. He cares about the panic to find the gold. And right now, the panic is fully funded by the biggest companies in the world. But then you have the other half, the product side.
The people actually looking for the gold.
The gold miners, the large language models, OpenAI, Anthropic, xAI, all the dozens of smaller players. And of course, the venture capitalists pouring billions and billions of dollars into them.
And this is where it gets dangerous.
This is where Damodaran identifies what he calls the big market delusion.
I love this term. It sounds like a psychological thriller. What does it mean in finance?
It's a very common psychological trap. It happens when a new market emerges that is undeniably huge, like the internet in the 90s or AI today. Everyone agrees the market will exist. No one disputes that AI is going to be a multi-trillion-dollar industry.
Okay, that part is a given.
Right. But the delusion is that every single company, from the biggest to the smallest startup, assumes they will be the one to dominate it.
So you have 100 different companies, and they all go to their investors with a pitch deck saying, we are going to capture 20% of this trillion-dollar market.
Exactly. But there are 100 startups all thinking they will take 20%. The math just doesn't work. 100 times 20% is 2,000%. You can't capture 2,000% of a market. Collectively, these companies are priced as if they will all win.
It's a mathematical impossibility.
Yeah.
It reminds me so much of the dot-com era. The internet was real. It did change the world. Amazon survived and thrived. But Pets.com still went to zero. Webvan went to zero.
Exactly. The thesis was right, but most of the stocks were wrong. And Damodaran actually ran the numbers on this for the LLMs. To justify the amount of capital being poured into them right now, the hundreds of billions from VCs, the industry essentially needs to generate $2 to $3 trillion in revenue. Eventually.
3 trillion.
Trillion. With a T, and to put that in perspective for you, OpenAI, the leader, is currently at a run rate of maybe 20 billion. They're hoping to hit 30 billion by 2026.
So we are at 20 billion, and the collective valuation implies we need to get to 3,000 billion. That is not a gap. That's a canyon. It's a chasm.
It's a canyon. The collective valuation of the product side of AI implies a future that is mathematically very, very unlikely. That is the delusion. Not that AI isn't real, but that everyone is going to get rich off it simultaneously.
So what happens when the math catches up with reality? When the VCs realize not everyone can win?
Damodaran predicts a cleaning up phase.
That sounds like a polite academic way of saying a bloodbath.
For the specific companies that can't deliver, yes. He thinks the VCs, the venture capitalists, are the ones who are going to be left holding the bag this time around. And this is a really important difference from the year 2000.
How so?
In 2000, retail investors got crushed on these garbage IPOs. Companies with no revenue went public, and people like you and me bought them. This time, a lot of this delusion is happening in the private markets, inside the walls of Sand Hill Road.
That's interesting. So the pain might be more concentrated among the professionals this time.
He thinks so. Now, despite this whole delusion talk, Damodaran said something that really surprised me. He actually defended bubbles. He framed them as a good thing, a necessary thing.
This was my favorite part of his interview. The anecdote he tells about his students.
The actuary versus the entrepreneur, it's brilliant. He asks his students at NYU a simple question. He says, do you want a world run by actuaries?
Actuaries are the risk calculators, right?
Mm-hmm.
The people who figure out insurance premiums based on life expectancy and, the probability of a meteor hitting your house.
Exactly. They are professional risk avoiders. Their entire job is to look at data and calculate the probability of failure. And his students always say no, they don't want that world. And Damodaran says, you're right. Because if actuaries ran the world, we would still be in caves.
Because an actuary would look at the first fire and say, too risky. It might burn down the forest. Don't light it.
Precisely. He argues that bubbles and overconfidence are features, not bugs, of capitalism. You need delusional entrepreneurs. You need people crazy enough to think they can change the world or else nothing new ever gets built. You need someone irrational enough to say, I'm going to build an electric car company when gas is $1 a gallon. Or I'm going to build a rocket that lands itself even when the actuaries say it's impossible.
So we need the Elon Musks and the Sam Altmans of the world to be a little bit delusional. Otherwise, they wouldn't even take the first leap.
And we, as a society, benefit from the infrastructure they build, even if their investors lose money in the inevitable correction.
Can you give an example of that?
Look at the fiber optic cables laid during the dot-com bubble. Companies like Global Crossing spent billions and billions laying cable under the oceans. They went bankrupt. Their investors lost everything. But guess what? We're using those cables right now to have this conversation. The modern internet exists because of the capital that was misallocated during that bubble.
That is a comforting thought, I guess. The bubble is the price of admission for innovation. The investors pay the bill, and society gets the technology.
It really is the engine of progress. It's messy and painful, but it works.
So, okay, we've established the market is richly priced, architecture is safer than product, and we need a little delusion to make progress. But everyone listening wants to know about the stocks they actually own. The Magnificent Seven.
The big guns. The companies that are basically holding up the entire index on their shoulders.
Damodaran went through them one by one, and he did not hold back. Let's start with the king of the hill right now, NVIDIA.
This is the one everyone is watching. And Damodaran has a really interesting personal history here. He's owned it for years. He's a value investor who bought a growth stock. But he sold his last stake recently.
He sold completely in the middle of the biggest run-up in modern history.
He staggered his sales over the last 4 years. He's not a market timer. But yeah, the last of it is gone. And he admits, he says he missed the last 25% gain or so.
Ouch. That's to hurt. I'd be checking the ticker every single day and just crying into my coffee.
You think so, but he says he sleeps like a baby. He calls it the sleep test. And for him, NVIDIA no longer passed the sleep test. He thinks it's richly priced. For him to buy it, or even keep holding it, at these levels, essentially everything has to go perfectly for the next 5 years.
What does perfectly mean?
It means perfect execution on their part. It means demand from their customers never slows down. It means no major geopolitical issues with Taiwan and TSMC. It means no significant competition from AMD or in-house chips from Google and Microsoft catching up.
And in this market, perfection is a big ask.
Yeah.
The odds of all of those things going right are low.
Very low. He acknowledges the big risk. If capital expenditure stops, if Microsoft and Google wake up tomorrow and say, you know what, we have enough chips for a while, NVIDIA stock drops like a stone. But as we established, they get to keep the cash they already made. So they won't go bankrupt, but the stock price could correct significantly, and he just doesn't want that risk anymore.
Okay, what about Microsoft? He seems to have a totally different attitude there.
Very different. He still owns Microsoft. He's had it since 2014. It's a core holding for him.
Why the double standard? I mean, why sell the hot AI stock, NVIDIA, and keep the other big AI stock, Microsoft? They're both AI plays.
It's all about what he calls the plausible pathway. He thinks it is much easier to construct a believable story, a plausible scenario where Microsoft justifies its current trillion-dollar price tag.
And is that because of their AI products, like Copilot?
Actually, no. It's because of the cloud. He views the cloud business Azure as a modern-day utility, like electricity or water.
How so?
It's incredibly sticky. Once a business builds its entire infrastructure on Azure, they aren't leaving. It's too expensive and too complicated to switch to Amazon or Google. So even if the AI hype dies down completely, even if Copilot is a flop, Microsoft still has this massive, robust, high-margin utility business that just prints money every quarter. It's a much safer bet.
That distinction between a hit product and a utility is key, isn't it? NVIDIA sells a product, a chip, that you buy once every few years. Microsoft sells the electricity you use every second of every day.
That's a perfect way to put it. Now let's talk about Alphabet or Google. This was arguably the most amusing analysis he gave.
The sugar daddy problem. I laughed out loud when I read this part of the transcript.
Yes, he laid out his 6 dwarves and 1 giant theory.
Explain that for us. Paint the picture.
Imagine a household. You have 1 giant, that's Google Search and its advertising business. The giant makes all the money. It brings home the paycheck every single week without fail.
Okay.
Then you have the 6 dwarves living in the house. These are all the other bets Google has made over the years. Waymo, self-driving cars, Verily Life Sciences, Google Glass, all their moonshots.
And the giant subsidizes the dwarves. The giant pays for all of their expensive hobbies.
Exactly. The search business is the sugar daddy. It pays for all the failures. Damodaran points out that corporate VCs, like Google's investment arm, are notoriously bad at cutting their losses because they can always go back to the parent company for more cash. If a normal startup runs out of money, they die. If a Google project runs out of money, they just go ask the search division for another $1 billion.
It creates a culture of laziness. There's no discipline.
It does. But he didn't hate the stock. He actually pointed out what might be the greatest single investment in corporate history, and that is YouTube.
Oh, absolutely. They bought it for what, $1.5 billion back in 2006? People thought they were crazy.
People thought they were literally burning money on cat videos. And Damodaran says it has paid off 100-fold. It's a monster. It's arguably the most valuable media asset in the world today. And he thinks with Gemini, their new AI model, they are finally starting to play the game better. They were on their back foot, getting punched in the face by OpenAI for a year, but they're starting to recover.
Okay, then we have Meta, Facebook. They're taking a totally different approach to AI, aren't they? They aren't really selling it, they're using it.
This is a critical nuance. Microsoft and Google are trying to sell you AI tools. Pay us $20 a month for Copilot. Meta, on the other hand, is using AI to keep you addicted to their platform.
It's the algorithm.
Precisely. Damodaran says the metric to watch for Meta isn't AI revenue, it's user time spent. If AI can make the Instagram feed and Reels just a little bit smarter, a little more addictive, so you scroll for an hour and a half instead of 57 minutes.
That's pure profit. That's more ad slots to sell and higher pricing power for those slots.
Bingo. It is terrifying for my personal screen time, but it's fantastic for the stock. They are weaponizing our attention spans. They're not selling AI. They're selling you powered by AI.
Okay, let's move to the most controversial one, Tesla.
Ah, the shapeshifter.
Damodaran called it a narrative shifter, and it's so true.
He did. He notes that Tesla is just amazing at changing its story just as the old story starts to fade. First, it was a simple car company. We build cool EVs.
Yeah.
Then as other companies started building EVs, it became an energy company. We build batteries and solar panels. Then it became a robotics company. Now the latest narrative is that it's a robo-taxi company.
And investors eat it up. They pivot with the story.
Some do. But Damodaran got out. He exited his position entirely because he says Tesla has become a political stock.
What does he mean by that?
He means that people are now buying or selling the stock based on their political allegiance to Elon Musk rather than on the fundamentals of the business.
Wow.
You have people who buy it because they see Musk as a free speech hero, and you have people who short it because they disagree with his politics. Damodaran says that is a dangerous place to be as a fundamental investor. Valuation is about numbers, not about whether you like the CEO's tweets. When politics enters the valuation equation, the noise becomes deafening. You can't model political tribalism in a spreadsheet.
That is a really good rule of thumb for any investor. If you find yourself buying a stock to make a political statement, you probably aren't investing anymore. You're campaigning.
Well put. And finally, just quickly, he touched on Oracle.
The gambler.
The gambler. Damodaran described Oracle as basically betting the house to get into the $1 trillion club. They see the Mag 7, and they have immense FOMO, so they're desperately trying to catch up by overspending on chips and infrastructure. He thinks they are overreaching. They're arriving late to the party and trying to buy everyone drinks to get noticed. It's a risky bet.
So to summarize the Mag 7, NVIDIA is great but pricey. Microsoft is a safe utility. Google has a sugar daddy problem but owns the golden goose in YouTube. Meta is weaponizing our attention. Tesla is a political battleground. And Oracle is the desperate gambler chasing the cool kids.
That is a perfect summary.
This all brings us to a deeper question about the economics of AI itself. I want to push back on this cleaning up idea for a second. Because the pitch for AI isn't just about selling chatbots. It's about productivity. The big corporate pitch is, I'm going to use AI, I can fire half my junior staff, my costs will plummet, and my profit margins will explode. That sounds like a valid thesis for higher stock prices across the board, not just for the tech companies.
It does, doesn't it? It feels completely intuitive. Efficiency equals profit. But Damodaran calls this the margin myth, and he uses a very simple, elegant example to dismantle it. The grocery store.
Okay, walk me through it. Why doesn't efficiency equal higher profit for everyone?
Imagine you own a grocery store. You operate on razor-thin margins, like 2%. You're barely making it. Then you buy a fancy new AI system that manages your inventory perfectly. No more spoiled milk, no more over-ordering bananas. You save 10% on your operating costs. What do you do with that extra money?
I keep it. I put it in my pocket. I buy a boat.
You could, for about 5 minutes. But the grocery store across the street, your mortal enemy, also bought that same AI software. Their cost also just went down 10%. And they decided to lower the price of eggs by 50 cents to steal all of your customers.
So now I had to lower my prices to match them or I'm going to lose my business.
And then the store down the block lowers their prices too. Suddenly that 10% cost saving isn't margin for you anymore, it's a discount for the customer.
So AI becomes deflationary.
Mm.
It makes goods and services cheaper for regular people, but it doesn't actually make the companies more profitable. The consumer wins.
Historically, that is exactly what happens with every major technology. It benefits the consumer, not the producer's margin. Competition forces companies to give the savings away to the customer.
That is such a powerful and counterintuitive point. We always assume efficiency equals profit. But in a competitive market, efficiency just equals lower prices.
Unless
There's an unlet.
Unless you are a monopoly. Or an oligopoly. This leads to the winner-take-all dynamic. The companies that provide the AI, the Microsofts, the Googles, the Amazons, they might see massive, sustainable margins.
Because there are only 3 of them. There's no grocery store across the street for them to compete with.
Right. If you're the only game in town, or one of only 3, you don't have to lower prices. You can keep the margin. Damodaran believes the tech sector naturally tends toward these monopolies because of network effects and stickiness. The Apple ecosystem or the Microsoft cloud, they create these deep moats that prevent users from leaving, securing that long-term revenue.
So the rich get richer, and the grocery stores just get cheaper eggs.
In a nutshell, yes. The providers of the tech win, The users of the tech just survive.
We've talked a lot of theory here, but I want to get to the Masterclass part of this deep dive. Damodaran is the dean of valuation. We can't let him go without learning how he actually values this market, because we've established he hates the PE ratio. So what does he use instead?
He looks at the equity risk premium, or the ERP.
Okay, that sounds like intimidating technical jargon. Can you translate that for the listener who, like me, hasn't taken a graduate-level finance class in a while?
Absolutely. Think of it as a menu of returns. You walk into a restaurant, the financial market. The first item on the menu is the risk-free special. This is a U.S. Treasury bond. The government promises to pay you, say, 4% interest. It is guaranteed. Barring the collapse of the U.S. government, you will not lose your money.
Okay, so that's my baseline. I can 4% without getting out of bed, risk-free.
Right. Now, looking further down the menu, you see stocks. Stocks are risky, right? The company could go bust, the market could crash. So if you are going to buy the risky item on the menu, you need to be rewarded for it. You need a premium on top of that 4% risk-free rate.
Of course, I'm not going to take the risk of losing all my money for a 4.1% return. I'd want, 8% or 9% to make it worth my while.
Exactly.
Yeah.
And that difference, the gap between what stocks are expected to pay and what the risk-free bond pays, that is the equity risk premium. It's the danger pay for being in the stock market.
Okay, that makes sense. So if the premium is low, if stocks are only paying a tiny bit more than bonds, then stocks are expensive. The reward isn't worth the risk.
You nailed it. Now, let me ask you a question. In the dot-com bubble of 1999, what do you think the ERP was?
I'm guessing it was dangerously low.
It was 2%. Investors were so delusional they were willing to hold incredibly risky tech stocks for almost no extra return compared to a safe government bond. That is the definition of a bubble. That is irrational.
And where is it today? That's the trillion-dollar question.
Damodaran calculates it, as of his latest paper, at 4.23%.
Wait, 4.23%.
4.23%, which is almost exactly the median historical average for the last 60 years.
So, let me get this straight. Despite the AI hype, despite NVIDIA's run, despite all the headlines screaming bubble, the actual danger pay for owning stocks is historically completely normal.
It is completely boringly normal. By the most fundamental measure of risk and reward that serious analysts use, we are not in a bubble. We are right in the middle of the fairway. And that, right there, is why Damodaran is sleeping soundly while everyone else is panicking.
That is a mind-blowing statistic given the current sentiment. It just cuts through all the noise.
And there is another dirty secret of modern valuation that he revealed. It's about how we define earnings and yield, and it's just as important.
Oh, this was good. He said you cannot do a discounted cash flow, which is the gold standard of valuation using net income from an income statement.
Right. He says that's a cardinal sin. Net income is an accounting number. It's not real cash. You can't spend net income at the grocery store. It's an opinion, not a fact.
So what should we be using instead?
Cash flow. Specifically, how much actual cold, hard cash the company returns to its shareholders.
And this brings us to the buyback revolution.
This is so critical to understanding today's market. In the old days, companies paid dividends. You got a check in the mail every quarter. That was your yield. That was the cash. Today, companies primarily return cash through buybacks. They use their cash to buy their own stock on the open market, which reduces the share count and makes your remaining shares more valuable.
Why did that shift happen?
It's mostly about taxes. Dividends are taxed immediately as income. Buybacks drive the stock price up, which creates a capital gain that you only pay taxes on when you decide to sell. It's much more tax efficient for the investor. Damodaran calls buybacks flexible dividends.
Okay, and here's the kicker. If you just look at the S&P 500 right now, the dividend yield looks terrible, doesn't it?
It's awful. It's about 1.5%. You'd look at that and say, why would I ever buy stocks? A T-bill pays 4%. But if you add the cash being returned through buybacks to that dividend yield, the total yield jumps to around 4%.
Which puts it right back in line with historical norms and makes it competitive with bonds again.
Exactly. The market isn't broken. The way most people measure yield was broken because we weren't counting the buybacks. We were ignoring most of the cash just because it came in a different envelope.
So if the public markets are surprisingly rational when you look under the hood, where is the insanity? Because it feels like there's insanity somewhere. I can feel it in the air.
He says in the private markets, the venture capital world.
The VC trap.
Damodaran believes the real bubble is happening in private valuations that we can't see on a public stock ticker. That is where you have AI companies with zero revenue being valued at billions of dollars. That is where the big market delusion is most concentrated.
And he made a great point about the safety of the public markets today versus 2000. Back then, the big public.com companies were all money losers. They were burning cash like crazy.
Right. Pets.com is losing money on every bag of dog food it sold.
But today, who are the big AI spenders? Who is funding this revolution?
It's Microsoft, Google, Meta, Amazon. These are the most profitable, cash-rich companies in the history of the world.
They could afford to lose money.
They can afford to waste $10 or $20 billion on a failed AI experiment and not go bankrupt. It's a rounding error for them. In 2000, if a company wasted $1 billion, they died. Today, Microsoft just writes it off as an impairment charge and their stock barely moves. That creates a floor of safety for the public investor that simply didn't exist in 1999.
That is a huge distinction. The floor under the market is solid this time.
The floor is solid for the giants. For the small, VC-backed startups trying to compete, there is no floor. It's a trapdoor.
Before we wrap up, we have to touch on something that felt a bit darker in his interview. Gold.
Yes, he brought this up, and it was a definite tonal shift in the conversation.
Now, usually when a finance professor talks about gold, they kind of roll their eyes. They call it a pet rock. It doesn't pay dividends. It has no cash flow. It doesn't grow. But Damodaran didn't do that.
No, he was surprisingly serious about it. He views gold not as an investment because, as you said, it doesn't produce cash flow, but as insurance against catastrophe.
And specifically, loss of trust.
That's the phrase that really stuck with me. He noted that gold is rising to all-time highs, and sophisticated investors like Ray Dalio are buying it. Damodaran interprets this as a signal that there is a structural loss of trust in our core currencies and institutions.
So people are buying gold because they don't trust the dollar or the Fed or the government to keep things stable in the long run.
Correct. It's a hedge against chaos. And while he isn't out there predicting the apocalypse, he is acknowledging that the catastrophe risk in the world is higher today than it has been in decades. We have major wars, sovereign debt crises, extreme political polarization. Gold is the barometer of that systemic fear.
He also mentioned that cleaning up phase, again, in this context.
Yes, he predicts a correction is coming at some point. And he warned that it will be painful even if the system is safer.
And he said when the correction hits, it punishes everyone, even if you're a value investor who doesn't own any AI stocks.
Because of indexing. The rise of index funds means that when people panic, they don't sell individual stocks. Yeah. They sell the whole market. They sell the S&P 500. So if NVIDIA crashes and drags the index down, your boring consumer staples stock goes down with it. It's the baby out with the bathwater effect. When the tide goes out, all the boats drop, not just the leaky ones.
But referencing back to that safety floor idea, he said that unlike in 2000, the Mag 7 won't go bust.
No, they'll just see their growth slow down. They won't disappear. And that is the silver lining in all this. The correction will be a valuation correction, not an extinction-level event like it was for so many dot-coms.
So let's bring this all home. We have covered a massive amount of ground here. What are the big actionable takeaways from the Dean evaluation?
I think number one is that we are likely in a big market delusion regarding the product side of AI, the LLMs, and the startups. But the architecture side, the chip makers, has already cashed the checks. That part of the market is safer.
Okay, number two, stop looking at PE ratios like they are a crystal ball. They're a thermometer. And you have to look at the context. You have to add buybacks plus dividends to see the real total yield of the market.
And third, and maybe most importantly, bubbles are the price of innovation. Don't fear them, but understand them. Know that they are a messy but necessary part of the capitalist engine that gives us the next generation of technology.
And I want to leave the listener with this final thought, which I found to be the most provocative part of the whole interview, the sleep test.
Yes.
Damodaran, the smartest valuation guy in the room, freely admits that he is holding stocks right now that he knows are probably overvalued.
Because selling triggers taxes. And because, as he says, timing the market is a fool's game. He basically said, I'd rather hold an overvalued Microsoft and sleep well at night than sell it and then stress every single day about when to get back in.
So if the Dean evaluation is willing to hold through a potential bubble because he knows he can't predict the pop, should you really be trying to day trade around it?
It's a very humbling thought. Sometimes the smartest move is to just do nothing. Just sit on your hands and let the magic of compounding happen.
Indeed. Now, before we sign off, we have to cover the legals and let you know where to find more of this.
The important stuff.
Disclaimer. Full, deep value research reports can be found in the description links. All analysis is based on publicly available sources and may be subject to revisions or differing interpretations. The content is for educational purposes only and does not constitute investment advice. Conduct your own due diligence before making investment decisions.
If you want to listen to our full deep dive about this topic or access more advanced contents, welcome to join Deep Value Club membership or subscribe us on deepvalues.com.